Okay, so good day, everybody. You're welcome to this morning's webinar. I'm going to take my time to just admit everyone who's in the waiting room currently so that we can kick off. I want to believe that last week everyone understood what we looked into. Last week we were looking into market structure, and I told us that this week, especially today, we'll be looking into price action. We'll be coming into a comprehensive yet simplistic understanding of what price action entails. All right, so that's basically what we'll be doing today. And I want to assure you that the recording will also be made available once the session ends. The recording is going to be made available on the Telegram group. And at the same time, I'm going to avail the recorded session on our YouTube channel. The link will be dropped later in the day. All right. So I think we can start now. Okay. So I'm going to start by sharing my screen. I have quite a number of windows open right now, but I'm trying to get across to the appropriate one. Okay, beautiful. All right, so all right, so to ease our work together, if you have any questions as I go on, please kindly drop it in the chat section. If you can hear me, if you cannot hear me, if you have a contribution, you can just raise your hand, all right, so that we can all move together at the same pace. All right, so I'm gonna quickly recap what we looked into over the course of the last session. During the last session, we were talking about market structure. All right, we're talking about market structure. And one of the core understandings that I was able to, that I believe I was able to drive into us is the fact that the market does not move, does not make all its moves at a stretch, all right? The market would usually, at every point in time, make moves in waves, all right? The moves that the market makes are usually in waves, such that you begin to have a bullish trend described as what I just drew on the chart, all right? And then after the bullish trend, the bearish trend is also like a zigzag motion sort of thing, all right? So having said that, I also explained last week the reason why it's usually like this. All right, I explained last week the reason why there is no consistent upward flow. All right, why the market doesn't just go up like an arrow. All right, I believe that I explained that, but I'm going to try to recap today so that for those who were not around last week, you can at least have an understanding, and then they can go watch the video, the recorded video for last week's session to get a clearer understanding of what it is that we did last week. All right, so the reason why the market structure does not follow a certain flow is because it's never at any point in time consisted of just one side of the market, all right? There is never a point in the market where there are only bears or only bulls. What do I mean by that? I simply mean that there's never a point in time in the market where there are only buyers and no sellers, or where there are only sellers and no buyers. All right. The reason is this: imagine if you entered the biggest market in your city, and then on getting to the market, you're trying to enter the market to buy, and then at the entrance to the market, you are told that, sorry, this market is only for sellers. We don't allow buyers come into the market. All right. I'm sure that that's going to sound real weird to you, because wherever sellers are, it means that that is where buyers should join them, because whatever you're selling, you need people to buy them from you. All right. And whatever you're buying, you also need sellers to supply you that. All right. And that gives birth to the concept of demand and supply. All right. The buyers are the ones that drive the demand, and the sellers are the ones that drive the supply, because They are the ones that make available the liquidity or the commodity that is being sold in the market. All right. All right. For those just joining us, you're welcome. You're welcome. You're welcome. All right. So as I was saying, the reason why it works like that is because there is never a point in time where um, the market wants or desires to be made up of just one part of the market, because it's supposed to be a balanced flow. All right. So having said that, we begin to realize that at the point where, say, for example, we know that this is a bullish market. All right. We know that the bulls are in control of this market. All right. However, the fact that the bulls are in control of the market does not mean that the bulls are the only ones in the market. All right. And the reason, and that's the reason why we have this short moves downwards. All right. This short moves that look bearish but are actually not bearish. They are simply called bullish retracements. Let me type that out for you. All right. So these short moves that look like bearish moves, all right, they're actually bullish retracement moves. So they are not in particular bearish moves. They are actually in reality bullish retracements, all right. So it's the bulls retracing. What does that mean? Let me give you an analogy. Say, peradventure, let's say you're trying to run a race, all right, or you're jogging, and you have quite a long distance to cover over the duration of your jogging. All right. We know that after a while, you've jogged for a while. All right. Along the line, you're going to take a short rest. All right. And then continue your jog, and then take another short rest, and then continue your jog. And the reason why you're doing that is because you still have a long way to go. All right. So the same way, in a bullish momentum, in a bullish market, all right, the retracements are points where the market takes a breather. All right. The market decides to take a short break before it continues the bullish run, and then it takes a short break before it takes a bullish run. All right. For those of you who are attending for the first time and may have difficulty knowing who I am, once again, my name is Adetola Freeman, and I am the lead instructor at EzFx Academy. And I want to say you're welcome to today's webinar once again. I'm saying this because of those who are just joining us. All right, so having said that, there are strategies that are built solely on understanding or on the interfacing between bullish momentums or bullish impulse moves. All right. These upward moves are called the impulses of the market. All right. They are called the bullish impulse. All right. Whereas the downward moves are called the bullish retracements. All right. So in a bullish trend, we have bullish impulses, and then we have bullish retracements. All right. So and that's basically what the Elliott's wave strategy is based on. The wave counts 1, 2, 1, 2, 3, 4, 5 ABC, or 1, 2, 3, 4, 5 XYZ strategy that is employed by Elliott's wave traders is actually based on this understanding, the understanding that the market moves in waves. So we have 3 impulse waves and then 2 retracement waves. So that's basically what, but forget I mentioned that, because I realized that some of you are beginners, so you might not be able to follow along. But just have that at the back of your mind in case you see someone trying to scream, "I'm an Elliott wave trader" and all of that, and then they are talking all the big grammar. Just know that what they are simply saying is they trade impulses and retracements. That's all. All right. There's no big deal to it. So if this is true for bullish impulses or for a bullish market, it means that the same also would apply definitely to a bearish market. All right, the same would definitely also apply to a bearish market. So having said that, I also showed us last week that there are times when in a bullish market, say for example, I was buying, and then I got to the price got to a point where I felt like, oh, I think I've bought enough. All right, this commodity is now has gotten to a point where I'm satisfied with how much of it I have. All right. Say, for example, somebody bought Bitcoin, like I said last week, bought it when it was $4,000. All right. And then right now, Bitcoin is at $10,000. All right. There's every possibility that some of those who bought from when one Bitcoin was $4,000, there's every possibility that some of them feel like, oh, right now I have enough Bitcoins. All right. I've made enough profit. I started at $4,000. Now I've more than doubled my capital. All right. So I think I've had enough. And then at that point where the person gets to, where Bitcoin gets to $10,000, the person can decide to sell off their Bitcoins. All right. To sell off their Bitcoins. And at the point where the person sells off their own Bitcoin, it would probably not be just one person. All right. So because that person at the point where they are no longer buying, what they do is that they sell it back into the market. All right. By converting their BTC into probably USD or something. All right. Or whatever currency they spend as their local currency. You understand? So at the point where they convert BTC back into USD, all right, what that simply means is that they sold BTC, all right? They sold BTC and bought USD, all right? Whereas before, when they used their US dollars to purchase Bitcoin, what happened was that they sold US dollar to buy Bitcoin, all right? So this is the relationship between the foreign exchange market. That's why it's called an exchange. You are constantly selling one thing to buy the other and buying one thing to sell the other, all right? I'm still going to explain in detail, but please just follow me closely. So at this point where market hits 10K, all right, the person sells their Bitcoin to buy US dollar, all right? And at that point, they would have made a profit of $6,000, all right, $6,000. So having said that, at the point where they make that sale, all right, because they are supplying Bitcoin back into the Bitcoin market, you discover that there's going to be a slight drop. There's going to be a slight drop in the chart, all right? Now, the Bitcoin that they just sold, all right, is going to be what some new buyers are going to be purchasing, all right? It's going to be what some new buyers are going to be spending their money to buy, all right? And at that point, this new bullish rally, this new bullish impulse begins again, all right? Some other people call a bullish impulse, they call it a rally, all right? So you can either call it a bullish impulse or a bullish rally. So I think that should settle that. All right, so let me quickly know in the chat section if you understood what I've explained so far before I keep going on. Before I continue, please let me know in the comment section if you understood what I just explained. I'm waiting. If you understood, or if you don't have any questions, please, I need you to type in the chat section, no questions for now. No questions for now. Let me quickly see that in the chat box so that we can progress. All right, beautiful. It's amazing. Thank you so much. All right, so we're going to continue. We're going to continue right about now. All right, so have understood that the next thing I want to explain to us is, because I know that a lot of us as traders, all right, you see things like GBP, USD, all right. Sometimes it's written together or sometimes it's written with a slash, all right. Sometimes it's written with a slash. All right, so you see commodities like GBP, USD, you see commodities like USD, USD JPY, all right, you see things like CAD CHF, all right. So I know you probably have questions like, okay, so why are these things written in pairs, all right? Why are the commodities presented to us in pairs, all right? And I'm going to also explain to you, because what we're looking into is practical price action, all right? I'm trying to help you get the understanding behind price, how it moves, why it moves, What influences it? All right. So so you have GBP USD, and the reason is because you see the chart that you see, all right, it's not a chart of GBP against USD per se, all right. It's not in particular a chart of GBP against USD. What you have on the other hand is it's a chart of the exchange rate, all right, the exchange rate, all right, exchange rate against time. So the chart of each commodity is a chart of exchange rate, the change in exchange rate per time. All right. So if I wanted to put this in fundamental equations according to physics, that would be change in exchange rate per time. All right. So that's actually what each commodity, commodity chart, this is actually what it represents. All right. So each chart you look at, each chart you stare at, each chart you take your time to have a look at. All right. This is exactly what it represents. So I'm going to quickly head over to a chart now to show you how this applies. All right. So let me quickly go to a chart. Okay. All right. So this is a chart of USD card. All right. This is US dollar against the Canadian dollar. All right. If you can see the chart, please, I need you to drop a comment in the chat box that you can see the screen. You can see the chart screen that I just dropped. All right, beautiful. So looking at this chart, all right, I need you to take a look at a part of it. Let me get this out of the way. Beautiful. I'm going to annotate it so that you can see what I'm talking about. If you look at this portion of the screen, all right, can you see where I'm highlighting? Can you see the highlighted region? Let me try to mark it out. Let me try to mark it out. Can you see this area? All right. What you observe is that you have figures like you're seeing figures like 1.21960. All right, you're seeing figures like 1.21960 and the likes. All right, and then if you look towards this axis, all right, which is the x-axis. All right, if you look towards the x-axis, you'll see that what you have there is actually time. All right, so on the vertical axis, we have a representation of exchange rate. All right, and then on the horizontal axis, we have a representation of time. All right, that's why you see that what you have here is the date. All right, the date and the time. All right, so basically every commodity chart is a chart that shows you the relationship between the exchange rate over a particular period of time. All right, so if you understood that, please kindly drop a comment in the chat box. Let me know that you understood that. All right, beautiful. So the next thing we're going to look into, I believe that we can all see the charts that I have on my screen right now. All right. And then you can also see that what I told you about the charts is actually buried through. All right. You see that we have an impulse. All right. We have an impulse. We have a retracement, a bearish retracement. We have another bearish impulse. All right. And then this movement, I'm not sure I might be teaching us this under the covering of the free webinar, but let me give you a hint. All right. At this point, this move is no longer a retracement. All right. This move is no longer a retracement. This move is actually, how do I describe it? It contains several small moves within it. All right. It contains several small moves within it. I want to believe that you can see the arrows that I'm drawing. All right. I'm using those arrows to show you the divisions of all the motions that are within this move, which is what informed my expert opinion that that was not a retracement. All right. So we see what you discover is the markets make this move, 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 and then this move. All right. So can we all see that, please? If you can see that and you understood me so far, please let me know in the comment section that you saw that and you understood. Just type, I got it, I got it, I got it. Let me see it in the chat section right now. Beautiful. Beautiful, beautiful, beautiful. That's amazing. That's amazing. That's amazing. All right, so thank you. So this is why, let me show you now why it is that the commodity is written in pairs. All right, why do we have USD CAD? Why do we have GBP USD? Why do we have CAD JPY? The reason is simple, but let me quickly head over to my whiteboard so that I can make it more explanatory. All right, so what you observe is this. In a chart of GBP USD, remember we are talking about foreign exchange. All right, so what we are trying to understand is how often are people exchanging GBP, which is Great British Pounds, for USD, which is short for United States dollar. All right. JPY is short for Japanese yen. CAD is short for Canadian dollar. CHF is short for Swiss francs. All right, Swiss francs. So all of these things, all right, what we're trying to do when we analyze a chart is to try to understand how often are people exchanging GBP for USD. All right. We're trying to understand how often do people exchange GBP for USD, which means what we're trying to do in excess is to evaluate which one of these two commodities do the people prefer. All right. Which of these two commodities is the people's preference? Are there more people buying pounds? Is the demand for pounds greater than the demand for dollar? Is the demand for dollar, is it outweighing the demand for pounds? All right. So this is what we try to do when we analyze a chart. And the reason is this. If the demand for pounds, all right, is greater than the demand for dollar, if it's greater than the demand for dollar, just imagine that pounds, all right, imagine that pounds and dollars, just imagine that the two of them are on a seesaw. They are on a swing. All right. They are on a seesaw. And both of them are just there. The seesaw is balanced. All right. That's the first scenario. The seesaw is balanced. But over time, all right, more people started gathering around pounds. All right. More people started influencing this area. All right. People routing, shouting, doing all of that and saying, oh, yeah, we believe in you. And then some of them even had the impetus to join pounds on the seesaw. All right. their weights will become added to the weight of the pound. All right. You know, initially both of them were balanced. There was stability in the market. That's what we call market equilibrium. All right. But right now, people are already vying more for pounds than for dollar. All right. As a result of that, this side of the seesaw is going to become heavier. Yes or no? Is which side of the seesaw is going to become heavier? Is it side A, where pounds is, or side B, where we have the dollar? Let me see in the chat section right now. All right, beautiful. So we see that side A is going to be the heavier side of the two. All right. As a result, what's going to end up happening is that we're going to have a market shift. There's going to be an equilibrium shift in the sense that at the end of the day, the seesaw is going to be tilted upwards. All right. You're still going to have your pounds here. You're still going to have your dollar here. All right. But right now, this is what we're going to be having on the chart. All right. So this communicates to you, or this describes to us that right now, pounds is heavier than dollar. All right. The pounds is heavier than the dollar. And as a result of that, what you will have on a chart, on a Forex trading chart, is a bullish momentum. If you were to evaluate a chart of GBP against USD. Did we get that, please? If you understood that, please let me know in the chat box that you understood that. Beautiful. So this tilt is what we are constantly seeing on the chart. All right. This tilt is what we are always repeatedly seeing consistently on a Forex trading chart. So whenever you have, say for example, let me quickly clear all my drawings. So say for example, you have a chart of GBP USD. All right. And that chart is bullish. So between pounds and US dollar, which of the two is heavier? Which of the two is having more demand? Which of the two are people demanding for the more? I want to hear your opinions in the comment section. All right. Thank you, Mr. Jake. Who else? Who else? Beautiful. Thank you, Mr. Jaffet. All right. Beautiful. So that means if the case was also reversed, all right, if we had a bearish chart on a GBP USD chart, all right, if we had a bearish momentum on a GBP USD chart, all right, which of the two is heavier? Is pounds heavier or US dollar heavier? Beautiful. Thank you, Mr. Jake, once again. So, which means now, the next thing I'm going to be showing us is correlation of prices. All right, what I'm going to be showing us now is correlation of prices. Have you been, I want to believe you've learned something so far. If you've learned something, I need you to just drop a comment in the chat box, you're doing well, or a thumbs up. Just let me know that I'm doing well. Let me know so that you understand I can have the momentum. All right. Thank you. Thank you. Thank you. I'm also gathering momentum. All right. Thank you. Thank you. All right. So we're going to look now into price correlations. All right. We're going to look into price correlations. Thank you, Mr. David. We're going to look into price correlations, and what we're going to be doing is we're going to be considering, if I'm looking at a chart of GBP USD, all right, for example, and then a chart of Euro GBP, and then a chart of Euro GBP, how will I be able to use these two charts to decide what I should do on a chart of Euro USD? All right. How do I use this information that I'm getting from these two charts? How do I use it to trade a chart of Euro USD? All right. So this is what we're going to be looking into next. All right. But as usual, we're going to have a very short 15 minutes break. We'll be back by 12 o'clock. But before we go for the break, once again, I want to remind you, all right, this is a free webinar and it's going to be free till next week, Saturday. All right. So we have, after today's session, we have just one more session. All right. So next week, Saturday, we're going to be doing the round of the free webinars. We might continue having the free webinars. I don't know yet. All right. I don't know yet. But the reason why we're doing this free webinars is because I have some free time on my hands right now, and I feel like just giving back to people. All right. So that's why I'm doing the free webinars. But hopefully, when our website is launched, whenever we are having a free webinar, you'll be notified via mail. You'll get the notifications in your inbox. We'll let you know that, oh, yes, we're having the free webinar this weekend and you can join us. All right. So from time to time, we may still have the free webinars, but for this particular section, all right, the last one is going to be happening next week, Saturday. And trust me, you don't want to miss it. Trust me, you really, 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 really do not want to miss it. All right, you really, really do not want to miss it. So why I'm saying this is because I want you to make as much publicity as you can. Tell your friends, tell your guys, let them know that there is free value somewhere. All right, these things I'm dishing out are expensive stuff. All right, they're expensive stuff. I have many friends who trade courses and will not even give you as much detail as I'm giving you right now. All right, they wouldn't even bother explaining this much, but I'm explaining this much because I am tired of seeing traders who know all the grammar, who know all the terms and terminologies, but are not profitable. All right, I'm tired of seeing traders who can explain Elliott wave, describe at least 15 harmonic chart patterns, who can talk about chart patterns from morning till day. They can recognize wedges, recognize flags, but if you check their account balance, all you will see is negative, negative, negative. All right, as if they were baptized in the blood of Jesus. All right, so I'm tired of seeing traders who know all the terms, but have little money to show for it. All right, so I'm trying my best to make it as simple as you can, so that at the end of the day, when you wake up in the morning and you call yourself a trader, you are not saying that because you know plenty grammar. You're saying that because there is evidence in your bank account to show for it. I'm not just a trader by mouth. I'm a trader by the things that I have handled. All right. So that's the drive behind this teachings. That's the drive behind this free webinars. I want to see a system of traders. I want to see a network of traders who are making money consistently. All right, without fear, without emotions. All right, and that's why these webinars are taking place right now. All right, so I want to say thank you very much for everyone who is in attendance right now. In the next 15 minutes, we're going to be continuing this session. I'm taking a break because, as usual, I need to take a drink of water or some little light refreshment so that my saliva can come alive again. All right, so that my saliva can come alive again. So I want to say a big thank you. In the next 15 minutes, we will come around again. All right, we're going to come around again. So please and please don't go nowhere. I'm going to be giving us the notification once it's time to continue. All right. So thank you once again. I'm going to be back in the next 15 minutes, and God